What are the best small cap stocks to buy over the next several months? The answer and the reasons might just surprise you. Small cap stocks have severely underperformed the major indices so far this year. Just look at this comparison between the ETFs representing the NASDAQ 100, the S&P 500, and the Russell 2000 or small caps. Here's the problem. The NASDAQ 100 is up 17.3% year to date, while the S&P 500 is up 14.6% year to date. Now, the Russell 2000 or small caps are actually down 0.2% year to date. So they're basically flat. But why is this? And more importantly, does it represent an opportunity to make money in this neglected segment of the stock market? Should you even consider adding small caps or keeping your current small cap holdings? This is an extremely important point, so keep watching to find out. Or should you avoid small caps altogether? Before we dive into why small caps have underperformed so far this year, what exactly is a small capitalization stock? Well, as you can see here, currently small caps are defined as publicly traded companies with a market capitalization of between $250 million and $2 billion. As you can see in this table up here, here's how the top 3,213 market cap stocks are currently distributed based on these definitions. So you can see we have 4% microcap, 32% small cap, 32% mid cap, 29% large cap, and 2% mega cap. So basically lump mega cap and large cap together, you've got 31% large cap or larger. Now, back to the topic of small caps. It's not rocket science why small caps have severely underperformed so far this year. There are two reasons. Look, since the beginning of 2022, the Fed has raised interest rates 11 times from a starting point of 0.08% to a current level of 5.33%. Now think about it. That is a whopping 66.6 times increase. That's insane. The second reason, look, the focus of investors and money managers has rightfully been on very large companies who stand to benefit from the shift to artificial intelligence, either directly or indirectly, like I'm showing you here. NVIDIA, Microsoft, Apple, Amazon, Meta, and Alphabet. Let's go back to reason number one, where the Fed has raised interest rates by almost 67x or 67 times since January of 2022. Why would that hamper the performance of smaller capitalization companies? Well, there are two reasons. Look, higher interest rates mean a higher cost of capital for all companies, but this matters way more to small companies that are at a higher risk of running out of capital because they have less resources. Sounds scary, doesn't it? The second reason is because large money managers tend to be value-based investors, meaning they take some derivative of earnings and divide it by the risk-free rate to come up with a fair value for a company. So when interest rates are high, like they are now, the calculated value of companies comes down. So what do these money managers do? Well, they sell these, quote, overvalued companies. I won't get into the details of treating small cap stocks as value plays here, but watch my video titled, Should Warren Buy Tesla? A Question of Value, to find out why trying to buy high growth stocks at a value is a fallacy. Link in the pinned comments below. So what do you think will happen when the Fed finally starts to lower interest rates in response to falling inflation? And which small cap stocks will be the best ones to invest in? Before we talk about that, it's important for you to understand that small cap companies are the up and comers. You'll notice as we look at this list, you won't recognize most of these companies, as you can see here. The Russell 2000 Small Cap Index is market weighted, just like the S&P 500 and just like the NASDAQ 100. So the more successful companies will grow their way right out of the index, leaving behind the less successful companies. In fact, Supermicro, as you can see here, is listed as the largest holding in the Russell 2000, but I can tell you that its market cap is already higher than $2 billion, so it's no longer considered a small cap company. As a result, I would not recommend including a small cap ETF in your portfolio over the long term. In this video, we're focusing on a unique situation where it's possible that small cap stocks could perform better over the next 6 months to maybe a year. So this is really a trading idea, not an investing idea. Let's go back to how to take advantage of this limited time opportunity. Most people won't or can't take the time to analyze 10 or more small cap stocks to select the best ones. But there are some great small cap companies with exposure to the boom in artificial intelligence that might be good picks. I'll put a link in the pinned comments below to this list of IWM's current holdings of small cap companies. If you're not inclined or interested in doing tons of research, then invest in the ETF IWM, as I've shown you here, or invest in one of ARK Invest's funds that focuses on innovative technologies. ARK Invest funds won't give you a pure small cap play, but the innovation companies that are viewed as higher risk by Wall Street should perform well as interest rates come down, as I fully expect they will later this year. As investors pour into the beaten-up smaller and innovative companies, these companies could move higher in a dramatic way. When it comes to taking advantage of the potential coming opportunity in smaller companies, you have two options. One, stay with your current allocation if it already includes exposure to small caps. Or two, add an allocation of small caps to your portfolio, either through the selection of individual companies or by adding IWM or one of the ARK Invest funds, or both. But whatever you do, dollar cost average into them over several months if you choose to go this route. As I cautioned earlier, this is a short-term strategy for potentially increasing your portfolio returns, and it's not a long-term buy and hold strategy. As a result, I wouldn't recommend this for most investors. Most investors will be well served by holding on to large cap stocks and ETFs over the long term. What do you think about small caps? Do you think they currently present an opportunity to play catch up with the large cap rally, or will they continue to flounder? Please let me know what you think in the comments below. With all that being said, let's take a look at the current health of the stock, bond, gold, and crypto markets. As you can see, when we look back over the last week, we've had a kind of an interesting market here. We've got the Dow finishing on top, which is unusual. We've got the NASDAQ second, S&P third, small caps fourth, and then ARK Innovation all the way at the bottom. So from my perspective, this looks like at least partway through Thursday and into Friday, we've had a flight to safer Dow stocks. But what's interesting is small caps also launched higher at the end of the day, along with ARK Innovation at the end of the day on Friday. And if we look back over the past month, well, again, kind of a mixed up rally here. We've got the NASDAQ on top, followed by the S&P, followed by the Dow, and then small caps and ARK are down here underwater. So again, and you'll see this in my other metrics, investors are staying away from small caps and innovation. And I think part of the reason is because interest rates are still too high. And how do things look year to date? Well, again, a very similar picture. NASDAQ on top, S&P, Dow, small caps, and ARK Innovation. And then if we look back over the past year, same picture. So until the markets recognize that the Fed's going to start lowering rates, and I think until the Fed does lower rates, small caps and ARK Innovation are going to stay stuck down here. But once the Fed starts lowering, these two categories should launch higher. And how does this show up in the current bottom dynamics? Well, wow, this is kind of wild here if you think about it. You can see that over this 2-month period, the S&P has been trending higher. Now, it hasn't just gone straight up, right? It's had a little pause here, and it's continued higher here, even though it's pulled back over the last couple of days. But you can see what's happened. The confidence level has fallen through the floor. In fact, it's negative down here. Now, it bottomed out down here almost at minus, call it 18%. And since then, it's started shooting higher for 0%. But you still have negative confidence level. That's kind of interesting. And then, we had it trying to form a bottom confirmation here. It didn't quite get high enough. Confidence level was almost high enough. The bottom confirmation level, this blue line, never made it up here to the high 90s, which is where it needs to be. And you can see it collapsed. And now, even though the market's moving lower over the last couple of days, the bottom confirmation signal's moving higher. So interesting picture here. And what if we look at risk versus opportunity? Well, I really like what I see here. You see this yellow line, risk acceleration, has been just collapsing over this past month or so. You can see it's just falling here. And the risk level, the red line, which is very much a lagging indicator, has finally started to decline here. And hopefully as this keeps coming down, this will continue moving lower. But again, it's a very lagging indicator. Now, on the opportunity side, opportunity acceleration has been just stellar. Look at this, increasing. And even during these down days, it was increasing here. This looks very positive. And then the opportunity level, which like risk is a very laggy indicator, you can see has been sort of slowly trending higher here. And then on Friday started to shoot higher, even though the market was lower. This looks really good. And what about equity versus safety? Well, let's jump right into the overlay. If we take a look at the overlay, I love the fact that the NASDAQ 100 is right here in first place. This couldn't be better, honestly. Could not be better. Now you can see small caps, as we've been talking about, are way down here in ninth place. So they have nowhere to go but up. And then look at cash. I like what cash has been doing. It really gave me some pause back here when cash was up in third place. It moved back to fifth place last week, and now it's moved down further to sixth place. This gives me a lot of encouragement. And if we throw the S&P 500 and the Dow on here, you can see that the S&P 500, just like the NASDAQ, has stayed put at least for the last 3 weeks. And the Dow is starting to move up. I think it displaced IWM, and IWM pushed the Dow up. What about safe haven assets? Well, this looks fabulous to me. We have a very healthy treasury market with the longest duration treasuries up here. As you go shorter in duration to 20-year, intermediate, and short-term bonds, this is a perfect relationship for a nice appetite for treasury risk. That was a mouthful. And you can see again that cash has moved down. Now I'd like to see cash below short-term bonds, but I'll take this. This is fine. This looks really good. And I like the fact that gold is stuck down here in 10th place. That says no inflation risk, and it says little to no geopolitical risk, which I know if you watch the news is hard to believe these days. And how does all of this show up in the buying and selling pressure? Well, this tells a very similar story to what we've been talking about. So for the Dow, you can see it pulled back here, but it has been moving higher. And you can see the buying pressure, this gray line, solid gray line, is trying to move higher here. And the selling pressure really collapsed over the past week or so. For the S&P 500, very nice move higher. And you can see that the buying pressure has been above the selling pressure, and now they're about at the same level after Thursday and Friday. What about the NASDAQ 100? Well, very similar to the S&P 500. You can see that the price has been moving higher, and the buying pressure is not only above the selling pressure, but it's still above the selling pressure, although it's pointing lower. Now, here's the problem, child. Look at small caps. Price declining while all these others are going up. Price declining, and you can see that the selling pressure and the buying pressure just kind of are noodling here, not going anywhere. Now, there is somewhat of a divergence here, And if you've watched my previous videos, you know I like divergence because it kind of gives you an indication that things can't stay the way they are. So if we look at the selling pressure, this orange line, you can see that it's declining. And if we look at the buying pressure, you can see that it's increasing, right? Now, increasing buying pressure with a declining price movement is a divergence. That tells me it's highly likely that small caps are going to start to move higher soon. It'll be interesting to see what happens. And what about ARK Innovation? Well, not quite the same picture as small caps, but not a very pretty one either. You can see that the price action has been very choppy and the overall trend since back here has been down. And you can see that the selling pressure is shooting higher here as of Thursday and Friday. So this really doesn't look good for ARK in the immediate term, but we'll see. And what about sector rankings? Well, as you know, if you've watched my previous videos, sector rankings tend to be a look in the rearview mirror, kind of like the CPI, right? This is how the markets looked way before last week, and this is how they looked probably a week or two ago. These are pretty laggy results, but you can see that the utilities normally being up here would be thought of as a safe haven asset, but in this case, utilities being up here are a risk asset. Because why? Artificial intelligence is putting huge demand on energy production, and that's causing investors to try and take a second order effect of that movement and buy utilities, which is driving them up here to be ranked number one. Now let's move ahead to sector rank acceleration, because these give you a little bit more real-time view. Not quite exactly real-time, but it kind of shows where things are moving instead of where they've been. And if you look at this, well, let's just switch to the overlays so you can kind of see the things I think are good here. Let's take a look. You've got clean energy up at the top. Why is clean energy at the top? Well, just like utilities, there's a huge demand for energy production, and clean energy is the best way to get there. It's the least expensive way, it's the least polluting way, and it's fairly quick to implement. So these stocks are starting to do well. We have technology in the 2, 3, and 4 positions. This is all very good. Even though this one moved down a notch, who cares? It's still up here at the top. We've got the NASDAQ 100 up here in second place, and we've got XLK, which is a technology ETF, staying put in fourth place. This looks very good. And now we've got cash moving down, which is a good thing. We like to see cash moving lower. I'd like to see it a lot lower than this, but the fact that it's moving down is good. We've got the Dow staying put. That's not a bad thing. And then normally, Treasuries moving up would be considered a bad thing if it were a flight to safety. But in this case, Treasuries moving higher is an indication that investors think the Fed is going to lower rates. So this is healthy for equities, which is why I've marked it in green. Consumer discretionary moved up. That's great. ARK Innovation moved up. This is fabulous. Emerging companies moved up. That's great. Emerging companies here, small caps moving up. That's also good. And I like the fact that gold has pulled back here and dropped in the rankings. Now, what isn't good in these two tables of last week to this week? Well, if we overlay what doesn't look good, I don't like the fact that the S&P 500 has dropped back here. And I don't like the fact that emerging markets has pulled back here. And I don't like the fact necessarily that consumer staples has moved up. Now, the fact that these are equities and they're moving higher, that's always good. But I'd like to see these either kind of staying put or stalling out here while consumer discretionary continues to move up in the rankings. And what about treasuries? Well, treasuries, as you can see, have really had a choppy ride here. They try to rally, they get whacked. They rally, they get whacked. And right now, this looks like somewhat of an unhealthy risk appetite for treasuries, although you can see that the longest duration ones, in fact, all the treasuries since Thursday morning have been moving higher. So that's encouraging. What about over the last month? Well, here's where you get the healthy look. The longest duration are up the most, up almost 5%, 4.5% in a month. That's really a good return from a safe haven asset. 20-year treasuries are up 3%. Excellent. This is a healthy appetite for treasuries. And if we look at year to date, you can see we bottomed out here and have been pretty much moving higher since then. This looks great. What about over the past year? Now, over the past year, thankfully, we didn't get back to these lows, but you can see we bottomed out, had a higher low here, and now we're rallying up from there. This looks very, very encouraging. And how does all of this show up in the buying and selling pressure? Well, you can see that short duration treasuries have been on a very nice price increase, and you can see that the buying pressure, this solid gray line, has been moving very nicely higher over the past month. What about intermediate treasuries? Somewhat similar picture, price moving higher, buying pressure moving higher. What about 7 to 10-year treasuries? Well, you can see that the price has been increasing, and for about the past month, the buying pressure has also been increasing, this solid gray line. In 20-year bonds, you can see that the price has in general been moving higher, and the buying pressure is on an upward trend. So this looks very, very good for treasuries. And what about that inverted yield curve? Well, yeah, we're still pretty inverted here. We're still almost 48 basis points or 0.48% inverted, which is not what you want to see. You want to see us becoming uninverted. Now, the only way that's going to happen is if the Fed starts lowering rates. Why? Because they control the rates down here at the short end, while the market controls the rates up here at the long end. And you can see that we've got a ways to go here before this becomes uninverted. Now, another way this could become uninverted is for rates at the long end to go up, way up. I would rather not see that happen. I'd rather these kind of stay put, come down a bit, but these come down a lot to become uninverted. And what do the markets think the Fed's going to do in 5 weeks, 3 days, 1 hour, and 53 minutes when they meet? Well, the market thinks they're going to leave rates right where they are. What's interesting, though, is this number was up in the 90s, as you can see here in the previous day. And I think in previous weeks before last week, it was up in the mid 90s. So this has come down a bit and this has come up a bit, indicating that the markets are starting to think maybe there's a small chance they'll lower rates in July. We'll have to wait and see what happens. In September, though, I love this. This has come way down. This was up here, I think a couple of weeks ago, was up here probably in the mid to high 40% range. So now there's less than a 50% chance that the Fed will leave rates where they are when they meet in September. In fact, there's over a 60% chance that they're going to lower rates. This looks very good. You go out to November and it gets even more positive that rates will be lower. So this is really going to help out innovative stocks and small cap stocks and stocks in general when these rates come down, because it's going to help the economy. And what about gold? Well, gold is kind of going nowhere. You can see that, right? I mean, you can see that it's pretty much where it was 2 months ago. Tried to rally. It's been pulling back. Not much happening here. You can see as it tried to rally, the buying pressure came up, but then really fell off. I don't think gold's going to go anywhere unless somehow inflation becomes an issue or there's geopolitical risk. And what about Bitcoin? Well, Bitcoin has been really consolidating for quite a while, and it goes back further than just this 2-month period. So you can see it tried to rally here. It's been pulling back. This does not look good, right? The price is declining, selling pressure is increasing, and shooting higher. Now, if there is any positive news in this selling pressure shooting higher like this, is that eventually it peaks out and runs out of steam and starts to pull back, and that usually is followed by a price moving higher. So we'll have to see where this peaks out and starts to fall back, but we could be in for a rally in the next week or two if that starts to happen. As you can see from the price movements and metrics in the buying and selling pressure charts for equities, the markets are still avoiding small cap and innovation companies in favor of larger cap AI exposed companies. But this won't last forever. Again, investing in short caps now is a short-term trading strategy and not a long-term investment thesis. So it's not for everyone. And if you decide to give small caps or innovation a try, dollar cost average into these investments over the next several months, not all at once. If there's one thing to take away from my market reviews over the past several weeks, it's that the equity and bond markets have been moving higher. But no one has a crystal ball. This is why I caution you to be an investor rather than a trader who tries to time the markets. Investments and investing aren't that complicated if you know how to allocate your portfolio without destroying your returns and getting little to no protection from downside risks. As an investor, you need to take the long view and allocate according to your risk tolerance rather than fretting about what's currently happening in the world or what everybody else is doing that you read about in the media with their portfolios. If you want to be a better investor, I discuss how to allocate your portfolios in 2 key videos linked in the pinned comments below, titled The Ideal Portfolio Using Just 2 ETFs or Mutual Funds, and The Ideal Portfolio Using Individual Equities. Again, link in the pinned comments. Until next week, I'm Calvin Rose, and thank you for watching Invest Smarter. That's all for now.
Stay up all night, gotta work now. Make up my mind and it turns around. Say that I'm fine till I burn out. Thinking this money sounded so nice. Ambush here in the strobe lights. Pay anything for the high price. This life feels like the sunny water